Ladies and gentlemen, good day and welcome to the Jindal Steel and Power Limited Q2 FY23 earnings conference call, hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Amit Dixit from ICICI Securities Limited. Thank you, and over to you, sir.
Yeah, hi. Thank you, Faizan, and good evening, everyone. On behalf of ICICI Securities, it's my pleasure to welcome all the participants for JSPL's Q2 FY23 conference call. At the outset, I thank the JSPL management for giving us an opportunity to host this call. From the management, we have with us Mr. Vimlen Jha, MD, and Mr. Ramkumar Ramaswamy, CFO. Without much ado, I would like to hand over the call to Mr. Gaurav Sancheti from Investor Relations, JSPL, to take this forward. Over to you, Gaurav.
Thank you, Amit sir. Good day, everyone. On behalf of Jindal Steel and Power, we welcome you all to this call to discuss results for the second quarter of FY23. We have with us our MD, Mr. Vimlen Jha, and our CFO, Mr. Ramkumar Ramaswamy. I would request Ram sir for his opening remarks. Over to you, Ram sir.
Thank you, and good day and good evening, everyone. Let me give a brief overview in terms of our operational and financial performance, and then we can open up for Q&A. So let me start with the sales volumes. Yeah? For the quarter, our sales volume was 2.01 million tons. This was higher than the last quarter by around 16%, primarily driven by the higher domestic sales of around 36%. This was offset by lower exports of 48%. Because of the export duty, we've seen the share of exports decline to roughly around 11% of our overall volumes as against 25% last quarter. The production was 1.82 million tons. This was lower versus last quarter by around 9%. This was primarily driven by shutdown in our Raigarh plant during August. There were also scheduled shutdowns in Angul during the quarter. Let me now talk about the realizations. Our NSR was lower by around 13% versus last quarter. Our domestic realizations declined by 9% and our exports declined by around 21%. If I were to give you a current view, currently we are seeing realizations stabilizing and our October realizations is broadly at around Q2 level. Costs, our SMS costs declined by around 8% versus last quarter. This was primarily driven by lower coking coal prices of around 6% and lower iron ore prices of around 24%. If I were to translate this into a rupees per metric ton, this would be around 3,000 rupees per metric ton of iron ore and around rupees 8,800 per metric ton of coking coal. In terms of EBITDA, our adjusted EBITDA for the quarter is around rupees 1,426 crores. This was lower than the last quarter by 50%, primarily driven by the factors that I just explained earlier. That is higher volumes, lower costs, offset by lower realizations. We also had an opening inventory that was sold during the quarter, which realized lower margins. The estimated differential due to this opening inventory is around 600 crores, which is approximately around 3,000 per metric ton. TAT. Let me talk about some of the adjustments that we made during the quarter. We made some provisions in the quarter that I would like to highlight. We have been providing loans to our overseas subsidiary, JSPML, of around $1.6 billion. Yeah? We have been reviewing and assessing the performance of these investments. As you're aware, some of our subsidiaries like AU, Australia, have not been delivering the desired returns. As a matter of prudence, we have decided to make a provision for the accrued interest on this loan, as well as the FX gain on revaluation of this loan. This accrued interest is rupees 765 crores, and the accrued FX gain is rupees 898 crores. The total value of these provisions that we made during the quarter is rupees 1664 crores. After adjusting these exceptional items, the PAT is a negative of rupees 473 crores, which is a loss of around 473 crores. Before these adjustments, the PAT is rupees 935 crores. Let me now quickly talk about gross debt and cash flows as well. We've been pursuing opportunities to refinance our loans at terms that are reflective of our stronger balance sheet. Accordingly, we've taken refinancing of around rupees 2779 crores end of September, which we've used for prepayment of some of our other loans in October. Accordingly, our gross debt end of September would have gone up to rupees 13,717 crores. This is currently at rupees 10,611 crores. It is important for you to note that the Q1 gross debt was rupees 10,764 crores. Therefore, our journey to deleverage will continue. Our net debt was rupees 7,334 crores, and the net debt to EBITDA is 0.66. I would also like to highlight that our overseas subsidiary loans have been fully repaid. I'll now quickly talk about the cash flows for the quarter. As an organization, we are fully focused on the cash flows, on generating cash. We started with an opening balance of 3,356 crores. We generated EBITDA of 1,426 crores. Because of our focus on cash, we released working capital of around 1,938 crores. As I mentioned earlier, we had the refinancing money coming in of 2,779 crores. These were the broad inflows. In terms of our outflows, we had an investment in our subsidiary JSOL of 850 crores. We paid advance tax of 673 crores. We made capital advances for the coal blocks that we have received of around 320 crores. Our scheduled loan repayment was 405 crores. Our overseas loan repayment was 320 crores. Our sustenance capex was 298 crores. Bank interest that we paid was 188 crores. And based on all of this, we ended up with a closing cash of 6383 crores for the quarter. If I adjust this for the BOB loan that came in, the closing cash would be 3,604 crores. Okay. I would also like to very, very briefly talk about our overseas subsidiary performance and then open up for Q&A. Overseas subsidiaries, they generated overall EBITDA of around 93 crores. Some of our subsidiaries like Mozambique and South Africa continue to make operational EBITDA. Australia, we have a negative EBITDA of around 69 crores. Yeah? And therefore, the overall overseas EBITDA was 93 crores. With this, I would like to close my opening remarks, and then we can move to Q&A.
Thank you very much.
Thank you, Ram sir. Gaurav this side. As always, we request all of you kindly ask more strategic questions. Our team is always there to give you the data points. With that, I probably hand over the call to Faizan. Over to you, Faizan.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The first question is from the line of Kamlesh Bagmar from Lotus Asset Managers. Please go ahead.
Yeah. So just one question on the part of this cash flow, like with regard to the proceeds which we got for the divestment of JPL. So there is one, like a footnote which is there that cash neutral to the extent of 4,380.
Sorry to interrupt you. The audio is not clear from your line, sir. Please use the handset mode.
Yeah. So one question on the part of this cash flow. Like in the cash flow, we have made one footnote that cash neutral to the extent of 4,386 crore with respect to the sale of stake in JPL. So what does that mean, and how much tax we have provided for that particular transaction?
So this was, I was just checking. So this is really, loans that have been transferred to JPL. That is what has been reflected over here. In terms of tax, I think tax we will be making the final provisions by end of the year.
Oh. So 4,386 is the net which we have realized, or like say I believe 3,000 crore was the equity component, and roughly if we say 4,400 crore, so does that mean that 1,400 crore has been the debt reduction?
Equity. See, the equity consideration was 3,015 crores.
Yeah.
And the loan that was transferred was 4,386 crores.
Okay. So, but what does that mean, that cash neutral to the extent of 4,386 crore?
Sorry, can you repeat your question, please?
So what does that footnote mean, that it is cash neutral to the extent of 4,386 crore?
Kamlesh sir, Gaurav said, I think we will give you the details separately.
Okay, yeah, great.
Thank you.
Yeah, thank you.
Thank you. The next question is from the line of Siddharth Gadekar from Equirus. Please go ahead.
Yeah, hi everyone. I had just two questions. First is on the coal mines. So when can we expect all the coal mines to be operational? If I'm not wrong, we had 4 coal mines in the past 6 to 9 months. So when can we expect all the mines to be operational and contributing at 80-85% utilization? This is my first question. Second, in terms of iron ore also, we had to ramp up the second mine. So when can we expect 100% utilization in that mine?
Okay, thanks Siddharth for this question, Bimlendra Jha here. First of all, with all fingers crossed, all caveats, I do hope in this country when I say that this is the date where I can do something, I do hope everything falls in place. By that measure, quarter 4 of the current fiscal is what we are expecting our coal mines to be operational and start giving us results. If you do it earlier, that will be great luck. If it is later, then it is bad luck. But otherwise, that is what is visible as of now to us from our plans. As far as iron ore is concerned, we are actually in a very sweet spot in India. And when we get iron ore cheaper from OMC, we source it from there. If that starts becoming more expensive, then we will activate more mining from our end. There is absolutely no problem. Both mines are operational.
Okay. So you mentioned fourth quarter of FY23, the coal mines will be operational.
That is what, with fingers crossed, with crossing my heart, I'm just telling you. What I don't know is what I don't know.
Okay, and when can we expect 80-85% by FY24 end or early FY25?
So, FY25, certainly. Again, if everything falls in place better, who knows?
All right, sir. Thank you.
Thank you. The next question is from the line of Prashant Kumar Kota from Emkay Global Financial Services. Please go ahead.
Good evening, sir, and thanks for the opportunity. I know the sector is under challenging circumstances. Within that, we are doing our best. So my question is related to the not related to this quarter per se, but generally on the capex program that we are executing over the next 2 to 3 years, about 18,000 crores plan. So these assets that we are building across various sites, are these all under the standalone entity, or are we building some assets under a subsidiary or a different company, etc.? Why I ask this, because this sometimes raises questions that in the past, will there be a spin-off, will there be a sale of it or something like that after spending, after getting them upright, etc. So this was just clarification I wanted from you.
Thank you for your question. We have a fully owned subsidiary called Jindal Steel Orissa, and most of the investment that we are talking about under this number that you said, which is without considering GST, under that, most of the investments are coming up under Jindal Steel Orissa. So, and because it is a 100% owned subsidiary, that does not mean we have to sell any assets or anything else other than the transfer of land that has to be there, which has to be under Jindal Steel Orissa. Does that answer your question?
Yes, sir. Where I'm coming from is in the past, for example, the Oman asset sale or the power asset sale. So something like that is not got anything to do with that, right? So it's just the operational.
No, I can categorically say no, because this is an integrated facility with the rest of the plant site, and doing anything like that would not be advantageous to us. It is much better to have this integrated site as a part of JSP with a fully owned subsidiary giving some benefits, and that is what we can explain.
Understood, sir. Understood, and that alleviates a lot of concerns of the investors. Thank you so much, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Pallav Agarwal from Antique Stock Broking. Please go ahead.
Yeah, good evening, sir. Sir, could you just actually give some more color on what exactly is this Forex one-off gain? I think we had this item actually even in the first quarter, I believe. So what exactly is this nature, and is it an exceptional item or it recurs every quarter?
Thank you. Thanks for the question. So as I mentioned, we have close to $1.5 billion of loans that have been given to our overseas subsidiary JSP Mauritius. And we have been accruing interest on this loan, and we have also been revaluing this loan based on the current Forex. So the gain that you see is based on this revaluation.
But in the Concall accounts, wouldn't that not be knocked off? Or you will still see a gain in the consolidated accounts?
You will still see a gain on the Concall level because the overseas entities are dollar reporters.
Okay, so it's more of a translation effect, is it?
That's right.
Sure. So the other question was on, coking coal. So, will we see any, what can be the reduction in cost in 3Q compared to 2Q in terms of coking coal?
Third quarter is your guess is as good as mine. So rather than making any forward-looking statements, what I would say is keep our finger crossed that it doesn't go through the roof again. But if it does, we keep low inventories and keep ourselves very agile to the market. That is all that I can say, but I do hope that it does not go back to the kind of numbers that it has gone in the past, only recent past. But then that is only technically possible when steel prices also start rising. So what happens to that margin, we do not know. But keeping low inventories is one of the best ways to deal with the situation, because then you can be in line with the market either which way the wind blows.
Fair enough, sir, because some of the other, other major steel players have hinted for at probably $80 to $100 reduction in coking coal cost sequentially. So was just.
You might have a better crystal ball than I have.
Sure. Yes, thank you. That's it from my side.
Thank you. The next question is from the line of Ashish Kejriwal from Nuvama Wealth Management. Please go ahead.
Yeah, hi. Good evening, everyone. Thanks for the opportunity. Sir, two questions. One is, in this quarter, how our thermal coal prices have moved and impacted our profitability, and what is the status right now? And second question is on Australia EBITDA in your present in your.
Mr. Kejriwal, the audio is breaking from your line. Please use the handset mode.
Oh, is it okay?
Yes.
Hello. Okay.
So thermal coal, you are saying thermal coal prices, how they have moved in the last quarter with respect to the previous quarter. Is that the question?
Yes. First question is that because you have mentioned about iron ore prices falling by 3,000 rupees and coking coal down by 3,800, but you haven't mentioned about thermal coal prices which hit profitability.
800.
Sorry.
Not 3,800.
Yeah, 800. Sorry, 800.
And thermal coal has moved negative by 600 to 700 rupees per ton.
Per ton of steel.
For the quarter.
Yeah, $600 rupees per ton of steel you are talking about thermal coal?
Yeah, per ton of steel.
Yes.
And what's the status now?
What is the status now means?
Status now means have we started receiving some linkage coal from Coal India or e-auction prices are coming down, so how it is going to impact our profitability?
No, they did come down slightly, but then these prices move within a matter of weeks in either direction. So on one auction, if we bought it for 1.22, another auction we bought it for 1.4 or 1. And we gave up on another auction because it went up beyond 1.5. So it can happen any which way, and that's why we refrain from making any forward-looking statements on these, because God only knows how these things pan out.
Understood. The second question is on Australia. In your press release, you have mentioned that Australia reported EBITDA of $13 million. But in your statement, you are saying that Australia reported a negative 69 crore. So how to reconcile that?
Operational EBITDA is $8 million. Operational EBITDA.
Okay.
Okay.
And the rest of it is attributable to the FX impact, that was recorded during the quarter. The loans that they had, the loans to JSPML, which had to be translated, that was the FX impact because of that. Net, the Australian subsidiary had a negative EBITDA of 69 crores.
So you mean the $13 million is your operational EBITDA?
8 million.
So what is 13 then? In your press release, actually, it's 8 million is your operational EBITDA, but sir, can you elaborate more into it? What kind of forex loss is there? Because that's very confusing.
Yes.
No, it is not forex loss. It is the forex gain that was recorded, which has been written off.
So on Australia had loans that were provided by their holding company, JSP Mauritius.
Okay.
These loans had to. You are aware that the US dollar has strengthened across all currencies. Because of this resulted in an FX translation impact, which overall resulted in a loss of 69 crores. If I were to give you the total value of that, the total value of sorry, I don't have that right away, but it is largely related to the FX translation impact of Australia.
Okay, I'll take it offline, sir. Thank you.
Yeah, and that's the case with some of the other geographies as well. Just to clarify. So you had operational EBITDA, and there were FX translation losses that resulted in a negative EBITDA for some of them at an overall level.
Okay. Thank you.
Thank you. The next question is from the line of Indrajit Agarwal from CLSA. Please go ahead.
Is Indrajit speaking? Because we can't hear anything.
One moment, sir. Mr. Indrajit Agarwal, your line is in talk mode. Please go ahead.
Yeah, hi. Sorry, I got disconnected. I had a couple of questions. First, in the press release, the one-off in the EBITDA that you mentioned, is it also related to the loans given to PML? Because that should ideally appear on other income or below EBITDA. So just wanted to understand if that understanding is correct, or is it related to any other item?
No, this is, as I mentioned, this is entirely related to the loans that were given to JSPM.
Sure. My second question is on the export mix. It has reduced in this quarter. I think earlier you had said that ideally you will have 20% of your volumes as exports in this year of your volumes of 8.1 to 8.2 million tons. Does that guidance still hold, or do you think that because of the export duty, your export proportion could be much lower than earlier anticipated?
If the international prices improve, we may be able to find it better to sell abroad. We are not finding it difficult to sell the material that we are producing. We have in fact liquidated most of our inventories. We constantly evaluate where to sell our material, and it is not as if we are consciously only wanting to export or a percentage that we want to export. It is a question of what gives us the maximum value. If domestic gives us the maximum value and we have enough demand, we fulfill that demand. If export gives us more value, then we will do more of exports. So let's not go by any guidance on percentage. We are not giving you any guidance on percentage. We are only giving you guidance to the extent that we will take the best possible action for creating more value.
So assuming export prices remain where they are, would there be a risk to the 8.1 to 8.2 million ton number as well, or that number remains as is or sacrificed?
No, we are actually seeing a very robust demand within the country for the range of products that we have. And therefore, we have no reason to believe that we cannot sell that quantity. Prices is another matter which, the roll of dice that the God holds, we unfortunately do not have control over.
Sure. Lastly, can you comment on thermal coal availability right now? Are you seeing any concerns, rake availability or actual shipment availability, or that is not a concern? Pricing could be volatile, but actual material availability, is that a concern, or that is fairly smooth?
Absolutely no concern, other than if something else happens that we do not know into the future. As of now, zero concern.
Sure. That's all from my side. Thank you very much.
Thank you.
Thank you. The next question is from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Yeah, good evening and thank you for the chance. My first question is on the coal mines. I believe you, in the previous question, you did mention sometime in fourth quarter, fingers crossed. So in our base case budgeting, I mean, what sort of volumes are we factoring for FY24 and 25? And if you can just, versus linkage coal, what sort of cost saving could come in from the captive coal mine?
You are again asking me forward-looking question. I will only give you a little bit of a hint that it is going to be substantially lower cost than our purchase coal cost. Now, beyond that, giving any specific numbers is not something that I would like to engage in because it is a forward-looking statement.
Okay, in terms of volume ramp up, just in base case, I believe, I understand there are a lot of externalities which can impact, but in your base case, what is the volume which you are expecting in 24 and 25?
Base case volume impact on this is that we would like to use at least 50% of the thermal coal that from our own mines, if not more.
Okay, but this will have a ramp-up period, right? I mean, 50% could be year one or gradually, eventually 50%?
So that is why I said 50% because that would be the kind of an average that we would be hoping for. Once again, when we hope for it, it all depends upon all the clearances, everything that happens, and which we are seeing no reason for concern. but who knows when what happens.
Got it. Secondly, on the volume, I missed the opening remarks. Are we continuing to guide for around 8 million tons for this year? And also just want to know, based on our rated capacity, given that next year for the large part blast furnace won't be coming in, what sort of volume ramp up can we have from say 8 million tons this year?
It will be only incremental, if at all, and only plugging the operational losses wherever we have a little bit of performance improvement. And those are the kind of continuous improvement that all steel companies engage in. Most of the time, these are just about adequate to deal with the surprises that come our way. So do not look forward to a great increase as such on this number.
Okay, but our rated capacity would be 9.6, right? I mean, so from 8 to 9.6, at least 95% utilization can be aspired.
Yeah, aspiration is always there, and value addition aspiration is more than the quantity aspiration. So we do aspire to keep on continuously improve. We have very strong programs internally to have this continuous improvement work that we are doing. We have experience with that. So we have all the hope to be able to continually improve our performance and bridge this gap between rated capacity and actual performance. So I'm not saying that won't happen. But what I'm also saying is that what we do not want to factor in is that often many of these improvements are simply just about enough to deal with the surprises that the market throws on us.
Got it. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Ritesh Shah from Investec. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is for Mr. Jha. So just wanted to understand what are your three priorities when we look at say next 3 years or 5 years. That's the first question.
Okay. Thanks, Mr. Shah, for this question. Priorities, number one is stable operations. Number two is to continually reduce our energy costs because it is great for the environment and great for costs. It is also from an ESG perspective that we want to continually be in the right direction as far as our ultimate aim of net zero is concerned. So we would continue to work on our projects that allow us to move in that direction. There is, of course, readiness that we would also have in our DRI for accepting green hydrogen as and when that becomes commercially more viable. We would be conducting experiments to make sure that we are ready for it from a technical perspective. However, that switch would not be made unless and until green hydrogen is available in a commercially viable way. We are so given operational performance, consistency, performance improvement in terms of bridging the gap that I answered in the previous question, and becoming greener and more responsible steel producer, and that has two ways in it. One is reducing energy costs, which also incidentally improves the EBITDA performance, but far more than that, it is environmentally more friendly. And apart from all this, there is a continued focus on our CSR activities. This year we already had a couple of success stories where president level awards were given for our CSR activities, and it is the upliftment of the society which continues to be our focus.
Sir, thank you, sir, for the answers. A few follow-ups. So just taking a leaf out of the prior question which was asked, you indicated stable operations. So possible to couple this thing up with some numbers on scale and incremental ROC as we look at, given we have huge expansion plans which are under progress right now. That's the first follow-up.
I think you are very smart to ask the same question in a different manner, but you are expecting a forward-looking answer from me, and unfortunately, I'm not going to oblige you with this answer because I cannot give you any forward-looking statement.
Sure. Just another follow-up, sir. How do you see the rationale for having overseas assets? Do you still buy into the argument that the company needs to have this overseas assets? And really, would it help the company going forward? That's one. And secondly, are we looking at any investments under government's PLI scheme? What is our thought process?
Okay, first of all, if India had enough coking coal, we wouldn't have had to look abroad. But you know that as far as India is concerned, we are net importers of coking coal from abroad. In India, there are not enough mines available in the coking coal area to be able to give us the raw material security for the future. And the volatility is extremely high in this area. Hence, it is prudent to keep looking for raw material assets abroad that can provide, in the times of high volatility, this kind of a protection. And therefore, our overseas assets continue to provide us that kind of an option, and it is a protection that is necessary in the steel industry from an integrated perspective. So yes, they will continue to be an integral part of our thinking and raw material security. As far as iron ore is concerned, it is plenty available in India, and we would obviously be wanting to do everything in-house in India. But coking coal, unfortunately, we don't have much of options available in India. Thermal coal, we have got all these Utkal B1, B2, and Utkal C, which we have now under our control. We have got Gare Palma 4/6, which is under our control, and therefore on thermal coal front we are likely to be completely self-sufficient. This is not something for which we would depend upon our subsidiaries abroad, and that gives us additional optionality of selling it in the external market. So it is actually a very good sweet spot that we are getting into. As far as PLI schemes are concerned, of course, we would be utilizing that, and let my CFO answer that question.
On the PLI scheme, let me just give you a bit of an overview in terms of just the scheme itself. Yeah, the total outlay for the industry is around 6,300 crores, and the investment period is 29 July 21 to 31st March 28, and the incentive period is 5 years commencing from 2023-24. The due date for filing of this application was 15th of September, and we have filed an application. Some of our upcoming projects, particularly the hot strip mill and the CRMs, they qualify for PLI incentives. So we made an application, and now we would be waiting for the next steps on this.
Sure, that's very helpful. I'll join back that you have more questions. Thank you.
Thank you. The next question is from the line of Vishnu Kumar from Spark Capital. Please go ahead.
Good evening and thanks for your time, sir. So you briefly touched about the demand, but could you be a little elaborate on the domestic and also on the international market, if you could speak about the demand trends that you're seeing?
So on the domestic market, the demand, you may be already aware that India is the only country in the world which is growing in terms of steel, steel demand and consumption. In India this year, we are expecting 2023 to be around 6.8 million tons. But there is calendar year 23 will be, what did I say? That was GDP growth, I'm sorry. 121 million tons in calendar year 23 as against 113 million tons in calendar year 22. Compare this to the Chinese demand of 914 million tons that was last calendar year, which remains stagnant, and EU plus UK 159 is coming down to 157. At the world level, therefore, if you look at the numbers, 1796 last year is likely to be at 1814 this year, which is around 18 million tons only addition at the world level, whereas 113 is becoming 121, which is 8 million tons out of that is coming from India alone. So that's the kind of a demand situation that is there. Of course, there are many factors, including the Ukrainian war that is affecting energy crisis in in Europe, and that is leading to many industries being affected, demand being affected, that demand contraction being there. As a result, many players have even started shutting down big furnaces. So there is going to be also an opportunity as a result of that. And as far as India itself is concerned, whether it is the monetary policy or government supporting the localization or strong demand from infrastructure, construction and auto sector, all this is placing ourselves very well in the right direction. As far as the preference of West to look beyond China for production is concerned, that is also something that poses an interesting opportunity for India. And we are becoming more and more capable to meet that shifting of global demand. I hope that answers your question.
My question is more specifically this, near-term trends, which segments you are seeing a good growth pickup, anything like government projects, real estate, any specific segments you are seeing strong pickup on demand? That was more my question.
So you are aware that 7.5 trillion capex was announced in FY23 budget, and government also has all these initiatives like Gati Shakti, PLI scheme, etc., which are all supportive of steel demand. We can already see healthy collection of taxes, GST, etc. And all this is specifically translating into very healthy order book for construction, infrastructure and renewable energy, which all are dependent on steel. Fortunately for JSP, our product mix is squarely going into these areas, which are strong demand areas for the country as of now. So we are bullish on demand, other than the roll of dice that I keep referring to.
Got it, sir. And sir, today, if you were to sell within India and export markets, would you say that the gross margin, where would that number be? At least I'm just asking on a relative scale, you will make more in India or exports does help you, or which is higher, lower? And let's say it's 3 months down the lane, do you see exports duty going away? That's another separate question. And if so, you see that there is a chances of export picking up.
On an average, at the moment, India offers us better margins than export. And it is a combination of two factors, international prices and export duty. Of course, there are many products that have in our range that are not affected by export duty. And there we constantly watch the market, and whichever market gives us a higher realization opportunity, we go to those markets. So we will continue to watch this, and should there be an opportunity that opens up either due to removal of export duty or due to improvement in prices abroad, which can happen suddenly, then we are all the time prepared for it. And our near-term order book is healthy. We have no reasons to be worried as of now. So that is where we are headed in terms of margins. It is always decision every month in our SNOP process. We take that decision based on how we see the market, and that is how we book it. But every week also we analyze if we need to make any mid-course correction to that plan. But at this moment, India is a strong story with respect to margins.
Got it, sir. One final question. The comments in the auditor comments that has been given, just wanted to understand this JSPML and this Wollongong, this Coal Limited. Now, we do understand both of them are actually having a negative net worth. Now, at some point, if you were to consider that these you will have to completely write off. There are two questions. One, would you have to take an impairment on your consolidated books, and any sense on that? If there is an investment amount that you need to take a consolidated hit, and also is there any external debt or any subsequent hit that we should see if from these two entities if you get a write-off?
And maybe I can take that. Firstly, there is no external debt, as I have clarified. We have repaid all external borrowings, so there is no external debt. The second is, as I mentioned, we are assessing the performance of these subsidiaries. We are assessing, their ability to generate the desired level of returns. And we would, of course, have to evaluate that in the context of, impairments that you mentioned. Yeah? I think the exercise is on. And once it is completed, we will definitely keep you suitably updated.
Any rough number that we can possibly see? Because if Wollongong, we read that the net liabilities itself is about 2,700 crores in one of the auditor comments. So just trying to get a broad sense, would that be a very big number, or most of it is actually already part of the standalone into consolidated, so the numbers may not be very big. So will it be just some materiality is what I'm trying to understand.
See, as I said, the process of review is currently in progress. We will have to do a valuation. A lot of things have to get completed. So it will be very premature to give you an indication of a value at this point of time.
Got it, sir. Thank you.
Thank you. The next question is from the line of Kirtan Mehta from BOB Capital Markets. Please go ahead. Mr. Mehta, your line is in talk mode. Please go ahead with your question.
Thank you, sir, for giving this opportunity. Just going back to the coal mine projects where you have stopped giving.
We have stopped hearing your voice. So whatever we stopped giving on coal mines, please unmute yourself.
Is this better now? Are you able to hear me?
Yeah, now we can hear you.
Yeah, I was sort of referring to the coal mine projects that you were saying you are targeting around average 50% utilization level. In terms of sort of what I understand is the total project potential would be around 15 million tons. So would that mean that 6 to 7 million ton of the production across 5 mines we are targeting in FY24? And could you also sort of give us a startup date for each of the 5 mines that you are targeting in typical ramp-up period to achieve 100% capacity outputs?
No, what I answered to you was from a utilization perspective that we are hoping to reach an average of 50% of our thermal coal requirement on an average during the year would be from the mines. That is the answer that I gave you, not how much output we would have from the mines.
Would you be able to then clarify the output that you will be targeting from the mine, at least the startup date for each of the mine that you are targeting, and what would be the typical ramp-up period?
No, at this moment I don't have the numbers, and I wouldn't like to again make a forward-looking statement on the subject.
Okay. Another question was related to your capacity utilization, where you have suggested that we may not expect a much improvement into the output because some of the surprises might eat away those improvements coming through. So in relation to the sort of a 9.6 million ton capacity utilization level, what is a sustainable average utilization that we should look at? Is it 80%, 85%, is it 90%, or is it 95%? Where should we be sort of assuming in a normal year? Or average through the cycle, whichever way you want to answer that question.
Yeah, so average through the cycle, of course, has all these big shutdowns that happen in a blast furnace, etc. So, I won't be able to put my pen to paper without actually going through those numbers, saying that when was the last reline, when would be the next reline, etc. Those are the kind of things that we would have to go through in order to be able to answer this question. But I would say that on an average, above 90% capacity utilization is considered to be good capacity utilization in steel industry.
So does JSPL has a potential to sort of achieve 8.6 million ton, which will correspond to 90% utilization over next 1 or 2 years, or are there any constraints which stops JSPL from achieving the same?
Yeah, the only constraint is our own brain power. That is, we are hoping to constantly upgrade our skills, train our people, make sure that we are making right and intelligent choices, taking the maintenance at the right time, not making any wrong decisions. So this is the only constraint. It's all about people, about their skills, about that will to win. And more recently, all these, I first of all do not believe in these capacity numbers at all. Recently, we have had a day when we produced what we never thought we can produce. From a single BOF vessel, we were able to produce 54 heats in one day. It never has happened before, and I am not aware of any other steel company that has been able to do it. So what do I call that as a capacity? So sometimes these are the kind of things that when people are enthused, motivated, rightly skilled, they are able to surprise you with numbers that where capacity has no meaning.
Right, sir. One more question, if I may. You also made a comment that during some period you find buying from OMC cheaper than producing at your own mines. Typically, the buying from OMC will not cost you less than 2,500 to 3,000 rupees per ton of iron ore. So does that imply that at some point of time your production costs are even higher than that number?
No, that is not how it is. But there are many constraints that we sometimes face. For example, the kind of ore that you are mining, you may not get the right quality for the DRI purpose. At that moment, rather than beneficiating your own ore and spending little more money over there, you may be better off just buying it off OMC. So that cost is always a cost that is in comparison to the choice that you have in front of you at a given point in time. And that is where it is. We are in a very sweet spot, is what I said, that we have these choices that we can execute without overburdening ourselves, either on production front or on our ability to source these materials.
Fine, sir. Thanks for this insight. Quite helpful.
Thank you. The next question is from the line of Satyadeep Jain from Ambit Capital. Please go ahead.
Hi, thank you. Good evening, everyone. A couple of questions. One on the Australian coking coal mine. Just want to understand it. I think from the press release also it seems the volume ramp up has been.
Mr. Jain, please use the handset mode.
Hi, can you hear me now?
Yes, sir.
So a couple of questions on the coking coal. Just wanted to understand. I think from the press release also, it seems like there is a slightly slower ramp up in the Australian coking coal mine. I think initially the expectation was for a certain volume target and FOB delivered after washing cost of, if I'm not mistaken, $150 to $200 per ton. Looks like it hasn't been able to achieve that number yet. What is surprising you at that mine compared to earlier expectations, and can we expect some improvement in future there? That's the first question.
Yes, for the Australian mines, we have faced certain issues there, and it was related to some equipment. It was related to washeries. It was related to the way we were planning for our mines. And we have taken some actions to tighten those kind of things and make sure that we have the multi-bolters, that there is a washery that comes up. So these things are going on as we speak, and the performance improvement we can see on a day-to-day basis. However, there are also in an underground mine, there are lots of uncertainties that are there. These uncertainties we are dealing with, but we are seeing a constant improvement trend, and we do hope to be able to remain on that track.
Okay. Thank you. Second question is on the capital allocation. The debt has reduced significantly to 7,000 crores. There is a capex plan that you have for the next 3 years. It looks like about 5,000 crore annual capex. But that should, if market conditions are okay, that should be met from internal cash flow. So the target of being net debt free remains intact, and there will be no organic or inorganic growth till you achieve that net debt. Apart from the ongoing capex, no additional organic or inorganic growth till you achieve that net debt target. Would that be a fair assumption?
I think, as we've stated before also, we would like to operate on a fairly conservative net debt to EBITDA of less than 1.5 through the cycles. Yeah, so I think that is what we have been repeating. In terms of organic or inorganic growth, we will be constantly evaluating options. I mean, you have a slate of projects that we have. There could be inorganic opportunities that might come up as well. We will have to evaluate them, and if they are going to be value accretive, we will make selective choices at that point in time.
But your product mix is going to be fairly balanced between flat and longs after the ongoing expansion. If you look at the inorganic opportunities, would there be a preference to skew to get maybe have inclination towards more longs or flats? If you look at any opportunity,
our bias is towards value, not towards long or flat, and we will maintain that bias.
Just if I can squeeze one quick question. So you mentioned being hydrogen ready. Hypothetically, let's say the cost of hydrogen is competitive in the next decade or so. The current DRI operations, and given your own experience in Europe also, can the existing DRI operations take hydrogen as it, or do you have to and maybe make some operational changes or maybe have some higher capex to be able to make it hydrogen ready?
So first of all, let me tell you the syngas that we use is already having 52 to 56% hydrogen in it. Now, that means we are already using hydrogen as a reductant in our DRI. So it's not a new technology that we are going to use. Now, the question is that can we try and increase this percentage from 52 to 56 to let's say 70, 75, 80% using even grey hydrogen, and then wait for the time when green hydrogen is available in order to and economically available in order to be able to then simply switch. So we are already experienced with using hydrogen as a reductant in our DRI. B, we are experimenting with what it takes to increase the percentage of hydrogen in the current situation, and if there are any modifications, etc. required, we are looking into that one. And therefore, we are, as on date, the most hydrogen-ready company, certainly in India, if not in the world, to be able to leverage the opportunity as and when it comes.
Okay. Thank you so much. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to Mr. Amit Dixit for closing comments.
Yeah, I would like to thank everyone for attending the call and fruitful discussion we had this evening. I would now like to hand over the call to Mr. Jha for any closing comments. Over to you, sir.
Thank you very much. I think these were very good questions and nice conversation that we had. At least I enjoyed it. I hope you did. It is good to ask these questions and keep us thinking. With your questions, we also start thinking of new things. So please keep coming back to us with your intelligent questions like these so that we can keep thinking of new things that we can do. I hope that you have been able to see that as far as operational performance is concerned, hopefully you are able to see very clearly that JSPL has returned on operational basis much better results than any of the results declared so far. And we are on a positive trajectory with the right kind of product mix at the moment for where India is growing. We hope to be able to continue on our journey towards zero debt in our parent at JSP level. And we also hope to be able to continue to work on our organic growth program on time, in budget, and in full. So this is where we are headed. Thank you for your support and have a good day.
Thank you. Ladies and gentlemen, on behalf of ICICI Securities Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.